Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we get someone in to the offices here at interest.co and talk about the things we care about, the economy, interest rates, property. And of course, we've got Olly Newland here today to talk about property. Olly's a regular contributor on our site and provocateur when it comes to comments. Olly, welcome back to interest.co.nz. What are you seeing out there in the property market there at the moment?
Well, I've been telling everybody for the last 12 months that the major recession that everybody predicted, where property prices were going to drop 30% and 15%, hasn't happened. There are some ugly things here and there, there's no doubt about that, but the bulk of the market has stayed flat. And this is what I predicted 2 years ago, and this is what is happening now. There are some signs, in fact, of recovery, but let's not get too excited.
What signs are you seeing?
I see people coming to me, and the statistics which I have here show that sales are increasing, the average price is increasing, very slightly, but better than going down, and that there's more confidence out there, just a bit. We're not getting carried away here, but that's much better than it going the other way.
Why do you think that confidence is coming back?
I think there's no doubt about the fact that people have looked back over the last 2 years and said to themselves, the world has not come to an end. We're still standing up. The streets are full of cars. The restaurants are full of people. Business is still going on. Maybe all this is a bit overrated. Let's get on with it.
And what do you think, though, about the idea that prices are still overvalued relative to incomes?
Well, now that's an interesting point. What happened during the boom is that prices got ahead of inflation, and there's no doubt about that. Now what we're going to see is prices staying relatively steady, and inflation, I suspect, is going to come and carry wages and prices up to the new level. And then we'll be off to the next boom, which might be years away, I know. But this has happened before, because I've been through 5 recessions and 5 booms, and there's been about 80 booms and busts in this country over the last 200 years. So I think we're just in for the same.
But the boom we saw between 2002 and 2007 was bigger than anything we'd seen before.
You weren't there in the 1970s. I promise you the 1970s boom was bigger than this one. I was there.
But what we saw after that 1970s boom was essentially 15 to 20 years where nominal prices didn't move much, as you say, but real prices dropped 30, 40%.
Well, well, with all due respect, Bernard, we're muddling up inflation with prices. I just said a minute ago, prices got ahead of inflation, and now they'll stay level. In a flat market, it's fine. I can make money, you can make money, everybody can make money in a flat market. That's fine.
How do you make money in a flat market?
If I told you that, I'd have to kill you. But, you can, believe me, you can. There's no problem there at all. But a market that's falling, that's bad news for everybody. So a flat market or a rising market is good for business.
Now, looking more in a more close way at the real estate market, you look. We're not just talking here about residential, but also commercial.
Yeah.
And you tend to invest more in retail, commercial property. What are you seeing there at the moment?
Well, I wouldn't say I tend to invest more in retail, but it just so happens that the preponderance of investments recently have been retail, and this year I bought quite a number of heavy commercial retail properties. But what I'm seeing is steady as she goes. In fact, prices are rising for good properties. In other words, yields are dropping substantially. There have been some incredible sales where yields have been so low that it makes you gasp. But generally speaking, it's been flat again. And there's some ugly things going on the fringes, no doubt about that. But retail's, it's not easy, but retailers by their very nature complain, so you can't take too much notice of that. And I've been buying up big retail blocks, and my particular interest is buying dead or nearly dead buildings and breathing life back into them, but that's a bit of a specialist business. But people are out there buying commercial property because the returns are better than the bank, plus hopefully a bit of capital gain.
And how do you breathe life back into these buildings?
Well, it's the same answer as I gave you before.
I'm dead again.
That's right. But, well, in very simple terms, you've got to take this building and look at what the problems are with it, and you've got to decide whether you can solve these problems or not. If you cannot solve these problems, you don't touch it, and that's just tough luck for whoever owns it. But if you think you can solve these problems, you give it a go, and this is what I do. What
about the problem, though, with New Zealanders not spending so much or growing spending as much? They tend to be saving a bit more, and the retail sales sector has really struggled in the last couple of years, and this Christmas doesn't look to be much better. How can you invest in retail commercial property when retail sales aren't going that strongly?
Well, firstly, as I said before, retailers are always complaining, so you can't take too much notice of that. But if you are investing in retail and a shopkeeper leaves, fortunately, there's usually 100 more shopkeepers ready to give it another go. To me, it makes no difference who's actually standing behind the counter as long as they pay me rent. And some retailers are stronger than others, and some are struggling and they go under. But this is common in good times as well. It's not easy for them, I grant you that, but I must say that I'm not complaining.
And the change in the structure of retailing, where a lot of the smaller independent retailers see some of their business go to the big chain stores, which are in those big outlet malls, or the likes of St Luke's or Sylvia Park. You're investing in those properties where smaller, more independent retailers are.
Yeah.
Isn't that a risk that,
No.
as we see more transfer to the big box, those small retailers struggle?
Well, as soon as they transfer to these big supermarkets or malls, they're paying 10 times more rent than they are anywhere else. And what's happening with the retailers becoming now destination shops, that is to say more specialist, which they don't necessarily have to be in a mall. So specialist shops, or destination shops as they're called, are springing up all over the place, and they're taking over the place of the generals of mum and pop businesses in the retail area. So that's fine. It doesn't make any difference.
And the GST increase hasn't hurt at all?
Well, from my point of view, it makes no difference because you claim it and you pay it back, and you claim it and pay it back, and so forth. It may hurt the people in the street, and I think that's been a break. I think the GST increase and the wage, salary cut or tax cut was a waste of time, frankly, but that's my personal opinion.
Why do you think it was a waste of time?
Well, I just think it was just reshuffling the old decks on the old Titanic. I don't think people really feel better off at all. I don't think it's made much difference. You may disagree, but from people talking to me, they just feel that they're paying out on one hand and receiving on the other, and they're more or less square. And so I don't think there's been much of a balancing at all.
What we have seen now in the last couple of months is that some of the wealthier suburbs are seeing more volumes going through of the more expensive houses. Yeah. And that's lifted some of the median prices in some of those areas. Do you think that the tax cuts, particularly for those on higher incomes, has been funneled almost straight through into purchases of property?
No, it's not that. It's not that. It's the wealthier suburbs, as you call them, those sort of people who buy in the wealthier suburbs are unaffected by the recession. They've got the money and they buy. The recession in Maine has hit the poorer people, and that's a shame, but that's a fact. And you'll see that most mortgagee sales and problems in housing has been in the poor areas, because people in the poor areas just don't have the number of options that a person who's wealthy has. They just can't go to their uncles or their friends and borrow $100,000 and sort the problem out, while those in the wealthier suburbs can go down the road and see their friendly bank manager, or go to Aunt Maud or their grandfathers or something like that, and get a loan from them. So this is why the market is disconnecting. There's a big disconnect between the poor areas and the better off areas. And that's interesting. It's unfortunate for the poor areas and okay for the rest, but there is a disconnect there, which is interesting to watch.
And how do you deal with that if you're a rental property investor or some sort of other investor? Because if you're catering to those poorer tenants, then a widening of that gap could be difficult.
Well, I'm not quite sure how I'm going to answer that, but my advice to anybody thinking of investing in residential property is not to buy properties in the poorer areas. It's a big mistake, because the people there who are mostly beneficiaries or on basic salaries simply can't afford more rent, and the costs keep on rising. So if you're going to be a residential investor, you invest in better quality properties. You get a better class of enemy when you do that. And that's right. I don't know why people buy these poor little boxes, because they're bad returns and they're hard work. But, that's nothing I can do about that.
And we saw a report in the Sunday Star Times this weekend about landlords who were working with Housing New Zealand to lease out their properties to Housing New Zealand tenants. Apparently there's been some problems with that. Oh, yes. Do you have any views on that?
Yeah, well, this Bill English and the loonies in the Treasury really shot themselves in the foot. They took away the depreciation and discouraged people left, right and centre from buying residential rental properties. So that's stage one. Stage two, Housing Corp is flat out advertising, please landlords, please supply us houses so that we can rent them out to the poor. Well, you've just dissuaded them on one side, now you're out there trying to get stuff on the other. And people are complaining, those investors that buy these sort of properties are complaining that the returns are lousy, and they're stuck with a new super landlord, being the state, who just impose rents on them. And of course, once you buy a property with a 10-year lease, it's very hard to resell it, because you have to sell it with the tenant. So it's not for everybody.
Isn't there a risk then that those rental property investors who went through Housing New Zealand might be struggling and have to put their houses on the market? This could depress prices?
Exactly. And they have to put them on the market, and they have to sell them with the tenant, so you've immediately shrunk the market down to 1% of the whole market instead of 100% of the whole market, because not everybody wants to buy a house with a 10-year tenant in it. You know? So it's not everybody's cup of tea. It's okay for somebody who wants to put a property in the bottom drawer and forget it, maybe. But for the ordinary investor, take it easy. I wouldn't rush into it.
Olly Newland, thank you very much. Another in our series of double shot interviews. I'm Bernard Hickey for interest.co.nz, and there are links to Olly's website underneath this video if you wanted to get some more information. I'm Bernard Hickey for interest.co.nz.